Life insurance, thrills, chills, tax breaks, life insurance. It's not exactly the sexiest topic at a cocktail party. Mention it and watch people's eyes glaze over faster than a Krispy Kreme donut. But hold on! Before you run screaming for the cheese platter, let's talk about a special type of life insurance, Index Universal Life Insurance, or IUL for those in the know. IUL is like the cool cousin of regular life insurance. It does the same basic thing, pays out money to your loved ones when you kick the bucket. But it also comes with some sweet tax advantages and potential for growth. Think of it as a retirement savings plan that doubles as a safety net for your family. Not bad, right? Now, I know what you're thinking. John, this sounds too good to be true. And you're right to be skeptical. Like everything else in life, IUL has its pros and cons. But before we get into the nitty-gritty, let's unpack this financial mystery box and see what treasures and potential pitfalls lie within. Index Universal Life. It's like regular life insurance, but with a twist. Okay, imagine regular life insurance is a plain slice of bread. It's reliable, it does the job, but it's not exactly exciting. Now, picture IUL as that same slice of bread, but toasted, buttered, and topped with a mountain of avocado. That's IUL familiar, yet significantly more delicious. With IUL, you still pay premiums, and your beneficiaries still get a death benefit when you shuffle off this mortal coil. But here's the kicker. Your cash value, the money you build up inside the policy, has the potential to grow based on the performance of a stock market index, like the S&P 500. Think of it like dipping your toes into the stock market without actually diving headfirst into the deep end. You get some of the upside potential without the risk of losing your principal if the market takes a nosedive. But how does it work, you ask? Well, buckle up because we're about to enter the thrilling world of indexing. The magic of indexing, your money goes up but never down. Well, almost never. Remember those choose your own adventure books we loved as kids? That's kind of how indexing works, except instead of choosing between fighting a dragon or exploring a spooky cave, you're choosing an index to link your policy to. Let's say you choose the S&P 500. If the index goes up, your cash value goes up too. Cha-ching. But here's the best part. If the market crashes and the index goes down, your cash value is protected from losses. It might not grow as much that year, but it won't disappear faster than a politician's promise during an election year. This heads I win, tails I don't lose scenario is one of the main reasons people find IUL so appealing. It's like having your cake and eating it too, except in this case, the cake is your retirement savings. And eating it means retiring comfortably. But wait, there's more. Let's talk about those sweet, sweet tax advantages. Show me the money. The tax advantages of IUL. Now, let's be real. Nobody likes paying taxes. It's like getting a root canal, a necessary evil. But here's where IUL shines brighter than a disco ball at Studio 54. It offers some pretty nifty tax benefits. First off, the death benefit your beneficiaries receive is generally tax-free. That's right, the government won't be taking a cut of that money. Secondly, you can withdraw from your cash value tax-free up to your basis, the amount you've paid in premiums. It's like having a secret stash of cash that the IRS doesn't know about. And if that wasn't enough, the money you withdraw above your basis is taxed as ordinary income, not at the higher capital gains rate. It's like finding a $20 bill in your pocket, a pleasant surprise that can brighten your day. These tax advantages can be a game changer, especially if you're looking for ways to grow your wealth and minimize your tax burden. But remember, tax laws are about as stable as a Jenga tower after a few beers, so it's always a good idea to consult with a tax professional before making any major financial decisions. Remember the 2008 financial crisis? Yeah, not exactly a fun time for anyone, especially those who watched their retirement savings evaporate faster than a puddle in the Sahara Desert. But for those with IUL, it was more of a mere moment. See, because IUL offers downside protection, your cash value is shielded from market crashes. It's like having a financial force field that repels negative returns. So, while others were panicking and selling their stocks at a loss, IUL holders were chilling out, sipping their Mai Tais and watching their portfolios weather the storm. Now, I'm not saying that IUL is a guaranteed way to get rich quick. It's not a magical money printing machine, but it does offer a level of security and peace of mind that traditional investment options simply can't match. And in today's volatile market, that's worth its weight in gold-plated avocados. Section 6. IUL is not a unicorn. It has limitations. Okay, let's address the elephant in the room, or in this case, the limitations in the IUL policy. Because much like that friend who always forgets their wallet, IUL isn't perfect. First off, IUL is more complex than traditional life insurance. There are more moving parts, which means more potential for confusion. It's like trying to assemble IKEA furniture after a few glasses of wine, doable, but not without its frustrations. Secondly, IUL policies typically have higher fees than their simpler counterparts. This is because you're paying for the added benefits like downside protection and potential for growth. Think of it like paying extra for guacamole at Chipotle. You know it's going to cost you, but sometimes it's just too good to resist. Finally, the growth potential of IUL is limited by caps and participation rates. These are like the fine print on a credit card offer. Easy to overlook, but important to understand. Caps limit how much your cash value can grow in a given year, while participation rates determine how much of the index's gains you'll actually participate in. Section 7, to IUL or not to IUL, that is the question. So, is IUL right for you? Well, that's like asking if pineapple belongs on pizza. It depends on your individual taste and circumstances. IUL can be a great option for those looking for grow your money while minimizing your tax burden. Protect your principal from market volatility. Ensure your loved ones are taken care of, no matter what. However, IUL might not be the best fit if you stick with traditional life insurance if you value straightforwardness. IUL's higher fees might not be feasible for everyone. IUL is a long-term investment, not a quick cash grab. Ultimately, the best way to determine if IUL is right for you is to consult with a qualified financial advisor. They can help you assess your needs, goals, and risk tolerance and recommend the best course of action. Section 8. The bottom line, is IUL right for you? IUL is a powerful financial tool that can help you achieve your financial goals. It offers a unique combination of death benefit protection, tax advantages, and growth potential, all while providing a safety net against market downturns. However, it's not a one-size-fits-all solution. It's crucial to understand both the benefits and limitations before making a decision. Think of IUL as a bespoke suit. It can be tailored to fit your specific needs and goals, but only if you choose the right tailor financial advisor and provide accurate measurements, financial situation. So before you jump on the IUL bandwagon, do your research, talk to the experts, and make an informed decision that aligns with your overall financial plan. And remember, when it comes to your financial future, knowledge is power, and potentially a whole lot of tax-free income. Section 9. Disclaimer, I'm not your financial advisor, but I play one on TV. This essay is for informational and entertainment purposes only and should not be construed as financial advice. I'm a comedian, not a financial professional. Please consult with a qualified financial advisor before making any investment decisions. Investing involves risk and you could lose money. Past performance is not indicative of future results. Don't blame me if you make a bad financial decision after reading this. You've been warned.